Hey everyone, my name's Andy. My channel is Finding Value Finance. I say that a billion times. It almost comes out without thinking about it. I've got Scott back with me. He is the, I don't even know how I would pronounce it, his Twitter name. It's @_AG_, right?
Yeah,
so
that's right.
That's his Twitter if you want to follow him, if you like what he's saying. I'm sure he'll get a billion questions as people ask him for his opinion. Obviously, this is just financial opinions. No advice here is given. I brought him back on to talk about how he looks for investments and how he evaluates investments, kind of the process and sequence that he goes through to see if something's good, if something's bad, what sector's good, what sector's bad, all of that stuff. So, Scott, well, first off, thanks for taking the time and coming on the channel. I appreciate that.
Thank you for having me back.
Yep.
Thank you.
I always appreciate that. So how do you scan for possible investments? Like, what do you look at? How do you approach it? What's your process?
Yeah, I guess the first thing that I start off with, I think we've talked about this before, but I look for flow of money. So I think that's really important. So either a really good basing pattern or something that's just coming off the bottom. So like, perfect example is uranium once again, but I'll just show you my chart and how I really set it up.
Oh, and notice that we've got the same background, guys.
Yeah, so this is just an example of what uranium looks like. So one thing that I really like using is putting it on monthly charts and putting it on Heikin and Ashi. So what Heikin and Ashi chart normally does is that it takes out a lot of the noise. So as you can see, like, these are like, you can see a clear red trend down here. You see a basing bottom here, and then you see it come up, starting to come up. Like you see this pattern everywhere. So actually, if you look at like even Bitcoin, for example, I don't buy cryptos, by the way, but so Heikin Ash's work really well. This is my starting point. So if you look at Bitcoin, for example, you can see a red. And what I really like seeing in chart in terms of picking up the base is when it gets really narrow, like when the body of the Heikin Ashi bars get really narrow, I start getting interested. It's like a turning point. It's a potential turning point for me. So you see that all the way throughout. Yeah.
When they get narrow, what you're saying is the opening and closing price equal each other. And what that is the supply and demand balance is equalizing.
That's right. That's exactly what it means. So basically, obviously, during a downtrend, the reason why I don't want to pick a bottom when it's in a clear downtrend is because you just don't know when it's going to stop. So a stock or anything might be really undervalued, but unless the sellers and the buyers are equaling out, it's not an entry point for me. I want to see it turn around. I want to see it turn around by starting off with the Heikin Ashi charts, looking at the monthly charts, and then looking at the narrow body within the Heikin Ashi charts. And that's when you start really watching it closely. And then when the Heikin Ashi chart turns green, that's like a perfect entry point for me. So that's the starting point. Just start off with the really big picture monthly charts, and then look for these Heikin Ashi charts to turn green, really narrow bodies, and obviously just clear signs, like it's just flattening out, right? So when you see it flattening out, once again, when the rate of decline is slowing down, it means your buyers are equaling the sellers, starting to equal out the sellers. You're running out of sellers, and now it's ready to kind of turn. So this is the starting point for me. Monthly chart.
When you see a monthly chart and it's starting to get to narrow down like that, do you drill down into a weekly chart and then a daily chart and then a minute chart to try to catch? Well, maybe not a minute chart, but if you really want to catch the bottom, you just want to keep drilling down and down and down and down to get it, right?
Yeah, 100%. So that's when I'll probably just put it into my normal candle charts, and then maybe go down to the weekly chart to look to see if there are any clear, patterns forming.
And
so
when you say,
that's exactly what I do. So
when you say patterns, when you say patterns are forming, why do you look for patterns? Like what's the significance of seeing a pattern?
So patterns are really important in chart trading, for example. So you can see the patterns work out over and over again. Like I'll just throw a couple of lines here, but I mean, this is what you do as well, Andy. But like you can see these like triangles form very, there are obvious patterns. So if you know a few patterns within trading, it really helps you identify And the more you go through, the better you will get at this. But if you look at Bitcoin, for example, like you've got this very clear triangle, but another really interesting thing, as the Heikin National monthly is forming, turning into green, like, by the way, I don't invest in Bitcoin, or I've never invested in Bitcoin, but this is where I can kind of demonstrate chart reading. So this is, yeah, you can see this triangle form. You can see like a whole lot of resistance here. And finally, when it breaks out, when you squeeze up, like that's the first sign, you know, that's where I might sprinkle in. When you're squeezing up in a channel or a pattern like this, like a triangular pattern, then this is where I would probably try and, you know, sprinkle a little bit here to try and get my first entry. And I always use the scale in, scale out approach. So I never purchase any of my stocks in one big hit. I would sprinkle, like as it gets attractive, I would sprinkle in, sprinkle out. And so, yeah, so look for these obvious patterns in the weekly chart, and then you might want to get even crazier and go down to the daily charts. I don't know where that pattern is anymore, but yeah, here you go.
There she is.
It might become, yeah, it might become a lot clearer on your daily pattern, because look at how beautiful this triangle pattern is. So yeah, I mean, that's how I go about chart reading. And then once, so this is when you want to try and pick a bottom for me. But an even surer bet for me is when you're in a clear uptrend. So I'll just use Elliott as an example, because I did scale in a lot into Elliott during the last pullback. Like this was my biggest purchase during the last pullback. And the reason for that is, okay, so once you're in, so obviously Elliott bottom came off here. But once you, so my starting point, once the trends changed, and we're in a clear uptrend, my starting view is always the weekly chart. So I look for weekly chart to see the obvious signs of, so see here, so you've got a low here.
You take a big picture view and then you scale in. Now, another question I have, and sorry to interrupt, but
yes.
Do you use technical analysis only, or do you marry up fundamentals with it? Or is this just a starting point?
So technical, like charts for me is probably the most important starting point. So if I don't see the price turning around, or if it's not giving me a clear pattern, I don't really look at the fundamentals. So I'll go through like literally, like when I invest in sector, for example, I would look through a whole lot of companies and then pick out from just looking at the charts. If I like the charts, then I will drill down to the fundamentals to see if the fundamentals are also attractive and supports the chart. But yeah, charts are my starting point.
And why do you start at charts and not the fundamentals?
Because it's once again from experience. So I've had so many like companies that I invested in with like very strong fundamentals, and without the chart supporting them, whenever I invest into these companies without the chart supporting the fundamentals, I've just had to wait for ages and ages, and you just don't know when it's going to turn around. Like unless the chart is telling you that there's going to be a breakout soon, or you know it's trending the right way, you might be waiting for a long time. I don't want to wait. I don't want to wait basically. So I look at the charts first. If the chart's giving me green lights, then I'll get really interested. So the basic thing that I look for is weekly chart. It's really simple. So once you've turned around the corner and once you start the uptrend, you look to see the very basic, which is, are you putting in higher lows and higher highs? That's it, right? Higher lows and higher highs. So you've got low here, low here, low here, low here, right? So you're consistently putting in higher lows and higher highs. So highs are here, here, and here. So then on a weekly chart, the trend. The long-term trend is very clear in that it's an upward trend. So that's when I get really interested and go back down to daily charts. And this is how I timed my EL8 entry last time. So I've got most of my main entries were around this mark, and I'll tell you why. So you've got EMA. So I think 200 EMA is probably the most important. Because it's the mostly used, it becomes the most important. So if you look at the 200 EMA here, the reason why I went in and bought a whole bunch around here is because it came down to the 200 EMA.
Yeah, so just for everyone to understand, the 200 EMA is an average of the past 200 trading days. And then as each day progresses, it adds the new 1 day and drops the last day, and then creates the 200 average of the 200. And then it paints that line, that orange line that he has, just as a explanation of what a 200 EMA is.
Yes, that's exactly right. So yeah, so the easiest strategy for me is, just, okay, look, zoom, you can zoom out a little bit as well. So the charts just work, like they just work so well. Okay, so you know that there's a huge support around this area because on a weekly chart, you've closed around here. So you know that this is probably a very good entry point. And what I look for is a confluence of support. So you know that, the highest close on this run up was basically around 43 cents, 44 cents. Now, if you go back to the daily chart, what you'll see is, okay, you know that there's a major support there, but then you know that 200 EMA is also coming up to around the same area, which means there's a confluence of support, right? Which means it's a very likely area for it to start bouncing and turning around. So when we're in it, so just to reiterate the point, like when we're in a clear uptrend on the weekly charts and consistently putting in higher highs and higher lows, then this is, I go back to the daily chart and look for the 200 EMA to move up. And when the prices come down to test that level, then for me, that's a very good attractive entry point. So this is where I've kind of unloaded all my, the more significant holdings like Deep Yellow and Bannerman as well, Paladin, all those holdings. And because Elliott, as I covered in the last video, Elliott for me is a semi explorer and developer. So it's like it's a premature explorer with lots of potential upside in terms of the resource estimates. So I really like the company and know where they are in the life cycle of a miner. So yeah, I just wanted smaller cap plays just for the next 6 to 12 months, and probably even longer than that actually. And so yeah, this is where I loaded in, just coming down to 200 EMA.
So another thing that I want to just make clear with everybody is he's drawing those lines where we have turning points. So a stock is going up and then turns down, or a stock that's turning down and turns back up. And what that signifies is that you've got a misbalance in the buyers and sellers. So you're basically pushing the stock price to a certain point where the buyers or sellers exceed themselves. So it's a change in the buyer to seller ratio, so to speak. So you come up at where there's more buyers than sellers, it runs out of steam or runs out of buyers, and then the sellers take over and push the stock lower. And that's what we're signifying as a turning point to put a line, right?
Yes, that's exactly right. And then you marry this up with everything actually. Like, I mean, this chart is actually really, really good looking chart, because you can see here, like, I mean, there are multiple bullish patterns that are forming. So you've got the triangular pattern that's coming up. Like if you draw from here, if you connect all the dots here, what you see is a squeeze. Like we've talked about the squeeze before. Like this is a triangular squeeze. Like it's a pennant formation basically. And then on top of that,
let's try to describe what a pennant formation really is, and what it is. And do you want me to describe it, or do you want me?
No, I'll just show you, because I think it's just really easy. It's like, it looks like this basically.
And what I try to do is I try to put an explanation behind everything, because at least the way that I see it. So a pennant formation, when it comes, usually when it comes from the bottom side up, is a continuation pattern to the side that it entered. And then when you come, what it's doing is it's hitting it's bouncing and ping-ponging between two support and resistance lines. And the reason it's bouncing between those two is because it's coming to a conclusion between the buyers and the sellers. They equal each other out. So when you come up, there's an imbalance in the beginning, it hits the sellers, and then the sellers kind of get their way with the stock for a little while. The buyers take a run at it, the sellers take a run at it, and everything in the market is just trying to find a balance between buyers and sellers. That's what creates all these patterns. It's either you're hitting a wall upward, or you're hitting a wall downward. And then you come to a conclusion point where the buyers equal the sellers, which are most of the time, it's a contraction to an equal point. and then we see that break.
That's right. Yes,
Yep.
that's exactly right. And when you're squeezing up, the bigger the squeeze, the bigger the move normally, because it's like spring. You're suppressing a spring, and when it's squeezing so hard, like when it pops hard, which is what we've seen recently with Elevate. And so if you like this chart is like just so beautiful, because if I delete everything off the screen again, and let's just turn off the 200 EMA. Like obviously you saw the pennant form, but on top of that, you've got double bottom here, which is basically another formation. Where basically you're testing this spot twice before you run up. So it's a very famous pattern, very well-known pattern. And you've got the double bottom pattern, and then potentially on top of that, you've got inverse head and shoulder here.
Yep.
So when you see,
there's another one there too that you also have in that pattern. If you back out, it's got a funnel pattern too.
Oh yeah, 100% it does.
Because there's
so you've got everything. Pattern, so what Andy's basically,
you can go from the top to the bottom and do a funnel pattern.
Okay, so what Andy's talking about is this. So I've used Elevate actually to demonstrate my point around Livermore's bullish cylinder, and this is exactly what you get.
So really, you have 3 to 4 patterns all in one movement, and the reason that becomes important is because the support that goes underneath is that much stronger with the accumulation of patterns that it's creating over time.
Yes, 100%. So basically, if you look at
yep, it's called the confluence that you use, because some people don't know that word.
Yeah, that's right. So when okay, so the starting point is that on monthly charts, basically, just to summarize, on monthly charts, you can see the money flowing back in. Like this is a massive base. How long is this base? Like this is, you know, a 10-year base, right? And then you're just starting to turn around. You're seeing the money flow come in. And if you just put it into Heikin-Ashi, I don't know if you see it as clearly, but you can see like the Heikin-Ashis, the bodies of Heikin-Ashis turn into nothing. And then you get a solid green bar after a long base. And it's a buy sign there. And then as you go into weekly charts, you can see very clearly higher lows and higher highs, which means we're in a clear uptrend, and the market conditions are really good because we know that it's the market conditions are favorable to commodities right now. The money's rotating out of general equities and bonds and perhaps real estate into commodities. And then on a daily chart, you see these beautiful patterns. And on top of that, if you look at the fundamentals for this company, I think around here, they were trading at like $1 or less than $1 per pound in the ground of uranium with lots of exploration upside. So for me, it was like kind of a no-brainer. And if you absolutely zoom out, I think you talk about the fractals in charts as well. And yeah, I mean, I think it's really important when it comes to euphoria phase, is that, you know, people like the retail piling into these stocks will look at the previous side, not really, you know much about the dilution or the market cap or whatever it might be, and just look at the chart and go, that's cheap, that looks cheap.
Yeah,
so you know, it's another factor that
so here my question, and I don't know if anyone knows this or not, but and I think it should hold true, the size of that funnel should be an indication of, or a fractal or a DNA of the stock. Now, can I compare, you know how to compare stocks? I want to compare one thing to it, because I found one with a massive cylinder, and just to see how it compares to this stock here. If you can compare the plus sign there, LIACF to that one.
Compare it?
Yeah, compare it. LIACF. LIACF. And then zoom in, and hopefully they overlap good. You can just hit enter. It should enter it as a
okay. Hold on, sorry. I've just got a bunch of things here.
Oh, you're comparing a whole bunch?
Yeah, no, these are
LIACF, not that one. Okay, there you go. Yep, I just want to see how that compares. Put it on the
same percentage scale.
Yep.
Yep, well, look at that. They line up beautifully. Like almost perfect. Okay, this looks messy, so I'll just change this.
And remember, these the company I chose is a lithium company, and they trade almost in tandem. I don't know why, and they are somewhat correlated.
Wow, look at that.
You like that lithium stock I have, huh? That was one that I
like the chart.
had released to the website at that bottom of the orange. I've caught the bottom of the bottom right there. Yep, just recently.
Yes. Yeah.
But see the fractal of the lithium one may even be bigger, and that's what drawn me to that. The enterprise value, the market cap to the tons in the ground that they have of lithium is like one of the cheapest there is out there for that lithium stock. Good.
Yeah, so this is how I go about I guess just looking at investments and like picking my stocks, looking through the charts, making sure that you're in a clear uptrend. I think once the Livermore bullish cylinder plays out, like I think I've drawn this out before, but basically like you've got, let's just compare.
So
this.
here, let me ask a question. So we got the cylinder that's coming that you've got right there that's pulled up. What that is basically saying is that's a lead in to a much larger move, correct?
Much larger move. Typically what happens with the Livermore cylinder, like you can check out pretty much any stock out there, like Apple before it ran really, really hard, like Bitcoin when it ran really, really hard, like a lot of them show this pattern forming, like at the beginning of the bull market. And so if you look at this, it's like 1, 2, 3, 4, 5, 6, 7 is the last touchdown, and then 8 is the liftoff, right?
So what I used
1, 2, 3, 4, 5, 6, 7, and then
it's the liftoff.
Got liftoff.
And what I always called it was the double hump, because the first hump wasn't, sometimes you don't see it. So you see two humps as a lead in, and then you see a gigantic move, because that first hump is always usually so small. So I call it the double hump lead in. I didn't know what it was called. I didn't know Livermore had a cylinder. I didn't know any of that stuff. I just saw that all the time. I saw it on SM Energy on the biggest picture view chart. It had the little two humps, and then it just took off. SM Energy. If you take a really big approach, like all, if you go to all, we're talking like as big as of a thing that you can get. Go to all. There, see the little two humps in the beginning there? Hit
Are you talking about here?
Yeah,
that's almost like it.
The gigantic move that came after. So that fractal.
No, you absolutely see this pattern play out everywhere. Like I mean, you can find in so many stocks right now. Like like everywhere. It's this pattern for the uranium stocks is everywhere, which is very positive, right? Because when this is forming everywhere, absolutely everywhere. Like you see the bullish cylinder here. I've already drawn that in.
you've got the two humps too.
Yeah, and you see it everywhere. Like it's I don't own PN.
It's 3 if you can see the first one, if it's pronounced enough. Sometimes you can't see it.
Look at that. Yeah, it's everywhere. Absolutely everywhere. So
that's crazy.
Yeah, I think we are ready for launch.
Do you see? Yeah, I know we are. That's for uranium. Do you see this pattern anywhere else that you're looking? The cylinder, because I see it in lithium stocks. I see it in these stocks. I think some of them are playing out in graphite, perhaps.
Graphite,
and maybe even potash, like fertilizer stuff. I see every once in a while that they're like trying to play out something similar to that. They've got a little bit different pattern. And then some of the rare earths, I think I see every once in a while, 1 or 2 that has it, because I look at all these things. So after you find a chart that you really, really like, for instance, like these ones, what do you do next? What's the next step?
I go into the companies. So this is a little bit, uranium stocks are a little bit different. So basically this is the view that I've set up for myself. So if I'm going through like a typical company with cash flow or whatever it might be, I will typically go through the fundamentals, like just filter out the fundamentals using key metrics. So it could be a combination of market cap, it could be PE ratio, PB ratio, so basically price to earnings ratio or price to book ratio. I'll look at their quarterly earnings, their quarterly sales, net income, total revenue, everything. So I've got this set up, so I can easily then just scroll down and look at their key metrics to see if I'm interested in the company. Like what I would typically be interested in is rising book price, book value of the stocks, or rising revenue, rising net income, whatever it might be. So I'll marry that up with the fundamentals.
What do you look for in the fundamentals? So you look at all these things. Do you prefer like a speculative company, or do you prefer one that's like a turnaround story? Like what do you usually prefer to invest in if you had the option?
Yeah, so just depending on which industry you're in, I think. So if we're talking about something that's very cyclical, I like to see something just turn around, right? I like growth story. I like them, continue to add and build on their revenue, and typically the ones with higher sales and net income, because the higher sales basically means that the company is very leveraged to the price of the underlying commodity or underlying whatever it might be, the cash flow. So that's what I would typically look for. Like in commodities, if I was buying into a producer, like say for example gold producer, I would typically like something that's trading at very low price to sales ratio, then a low price to earnings ratio, because I know if the commodity moved up, you're going to get that much more leverage in those stocks.
So when you look at this, then you should see a mirror image of those who have way higher income and sales and revenue, I should say, revenue and income.
Yeah.
They should be, I should say, similar to the chart and the fractal in the chart. So those two should literally match up then.
Yes.
Yep. And if they don't match up, we may have there might be something fishy, or maybe it's a one-off Reddit squeeze or something like that, or who knows what.
Exactly right. Yeah, that's right. So the fundamentals definitely need to marry up with the charts. If the fundamentals are bad, I don't go in it either, because you can't just. I don't just trade based on charts alone. So chart is the starting point. I want to see the money flowing in, or basing out, forming a very good base. And then if the chart looks good, I know that there's going to be momentum behind it potentially, and that's when I will look at the fundamentals to see if it supports. Because with strong fundamentals, what it does really is it gives you a base to the price of the share. So it gives you the conviction to stay in the trade, even if the prices were to come down to a level that you didn't really expect. But if it doesn't have any fundamentals behind the stock, then you might just try and get out no matter what the price is. So it doesn't give you the conviction to stay in the trade. So that's why I consider the fundamentals very important as well.
So you don't just run around looking for chart patterns and then enter something with no fundamental backing, correct?
No, never.
And then
never.
what would you say about like a bunch of like biotech companies where people are investing and they're waiting for news to come out about some stage or level, whatever? Do you play any of that stuff?
No, I don't.
I don't either. And why don't you?
I mean, I feel like when you're playing those type of stocks, I think I mentioned it before to you, but when I invest in explorers, I don't invest in explorers that haven't hit anything. So I don't have any explorers on my portfolio that haven't hit uranium. So I feel like if you're buying into a biotech stock, they haven't really produced anything meaningful or valuable, then it feels like you're just buying into nothing. So you never know if the company's going to make any money. So that's not my cup of tea.
So really, when we look at these bottoming patterns, and I'm going to make a general statement here, just so everybody knows, and what I do myself, is I look for companies that are in commodities because the management team and the asset can be completely intact, but the commodity is literally bringing the company down. It has nothing to do with the asset or the management team or the fundamentals of the company per se, if the commodity goes to a certain level and goes below their cost to produce. So we can't really find this. We don't want to be going and trying to catch bottoms in a company that can control its selling price. That means they're just going to go bankrupt, right?
Yep.
For the most part.
100%. So when you're looking into any commodity, it's so important. Like when you're trying to pick the bottom, I think it's so important to see all the companies within the industry to see if there is actually money flow generally into the industry, like a broad eye in the industry. So Like, you don't want to just go into a company just because that company alone looks good. You want to look at the whole sector to see if there's actually money flowing into that sector. I think we've talked about money flow. Like, I mean, obviously there will be general flow of money into commodities right now, but then even within commodities, you can go into uranium or gold or copper or whatever it might be. Like, money might be flowing into uranium, but it might not be flowing into gold yet. So you don't want to be in gold stocks then. Or you could be any commodities, but you want to see that money flow into the general sector as well.
Yeah, and how do you choose outside of technical analysis? Is there any way that you choose these certain sectors? Like, is there a way to gauge how much it could return, or like at least how do you gauge it? How do you gauge like this one's better than that one? If for whatever, however you gauge it.
It's history, I think. It's just history, I think. So we've talked about the ratios before. I don't know. Do we want to get to shipping today? I don't know.
Well, it's whatever we want, and you can describe the overall general like approach on how you would get into it.
The general approach. Yeah, like it's basically, for me, it's like because of what I've talked about before, which is money flows out of general equities, which is a huge market, and bonds. Like the money has to flow into a sector, right? So it's really me. I normally measure stuff in Dow Jones or gold. They are my two key measures. So if it looks good against Dow Jones, which is general equities, where the biggest funds are, and if that looks good, if that looks like it's turning around, then I start getting interested. Measured in real money, if it looks cheap, then I start getting interested too. So those are the two key metrics. So
if we were to pull one up, and I'll just give you the thing, UX1 exclamation mark. That's the futures market ratio to, let's say, the S&P 500 SPX.
Yeah.
And how does that one look?
that one looks fantastic. So immediately you can see it. Like, you can see in the pattern that you've got this very long range bottoming pattern here.
Okay. And when you put that line across the channel, what does that signify? That top line that you put in there. What why is that important?
This is a key level resistance. So basically, with the fund, big institutions, they don't really want to get right at the bottom necessarily. They really want to start getting in or piling in when there's more liquidity in the market. So the liquidity only comes with big movements. So once it breaks out and once it starts going up like this is when the liquidity comes in. So the big funds that want to get into these investments, they need the liquidity to be able to trade, because they might have investment strategies or investment policies that determine what they can and can't trade. And if the market isn't offering them enough liquidity, the big money can't flow in just based on those policies. So once it breaks out and your volume picks up, like I don't think the volume's showing quite here yet, but if you look at U.UN, which is Sprott Physical Uranium Trust, you can see the liquidity picking up. Like, that's trading volume providing liquidity to the big funds now. And as the liquidity comes into the market, the bigger funds can participate a lot more. So I know John Quakes, I think, has been posting.
So what you're saying is, and sorry for cutting you off, I'm not trying to cut off. I just want to make sure it's clear to the viewers that they know this, because you've done this so much, just like I have. And it's good to have two people do this. You look for volume then on the right-hand side to kick up.
Yeah. Yes. 100%.
As it starts coming up, that's volume entering the market, and that's critically important for a move. Correct?
Yeah. 100%. So volume confirms it. So when the volume's dwindling down like this, it means like your sellers are not really interested, your buyers are not interested, and especially when it's basing, it just means, okay, the sellers are equaling out buyers. Like, no one's really interested in trading this. They're holding on to whatever position they have. They're not really selling or trading. But once the volume picks up, like, you've seen a huge volume pick up here, and you can draw a trend probably from, I don't know, something like this, where it comes down. Once it breaks out, I mean, you can draw multiple patterns, but once it breaks out, and when you see a big green candle like that with the volume, it means like money's moving in, like money's flowing in. And now, like, someone wants to buy this thing. So volume is very important. Yes.
And sometimes what I do is I'll do one that you just did, like a line across, and then I'll come down to the next one, and then I draw another line across. And the way that I view that is it's just how many times does that price action hit the line, and that signifies how strong that line is, that horizontal or whatever line. So the more times you hit a line, the stronger that is. And usually what happens is you squeeze up on it, and then you just get this massive break out of it.
Yeah, that's right. That's right. That's exactly right. I'm sure we'll see the squeeze. So, I mean, obviously we've squeezed into this one, which I've been posting out quite a bit.
Yep, the pennant formation.
Pennant formation here. Well, you can draw it multiple ways, but effectively you see a triangle, basically a triangle. Like you can see it here. Like you don't really need to draw exact lines, but what you can see is just squeezing up. Like we're ready for a breakout.
So you made an obvious thing here, and I always make this too. The patterns aren't necessarily the thing that's important, and it doesn't have to be drawn perfectly. What's important is that you're seeing an equilibrium between the buyers and sellers over time, and then it goes to I quote a dead period. That's on the tip there, that little dead period, and then you get a break. So that's
right.
It's knowing and seeing when the stock, the buyers and sellers start equaling each other, and it starts to move sideways with whatever pattern.
Yeah. So the way that I normally describe it is like it's like a car or a runner, like a sprinter. So a sprinter runs, they need a bit of rest before they take off. So here, like they might be eating or drinking, and they might be recharging themselves, and then they take another run, and then you'll probably form another type of consolidation pattern, whether it's like a pennant formation or a bullish continuation pattern. Like you'll just form bull
cup and handle.
You'll just whatever it might be.
Inverted head and shoulders.
It's basically like, Formula One. Like if you look at it, they always have pit stops, right? So you run hard for a couple of laps, you come into pit stop, you refuel, change your tires, and then run again. So it's like that.
Here's another cool thing to know. When the pattern goes sideways, you can't see my pen there. If the pattern goes sideways or it's angled downward, it's bullish. If the pattern is angled upward, it's bearish. It wants to turn and go back down. So that's the general rule of thumb there.
100%. So, all right. So here's baseload, which I've tweeted about it having like the most beautiful bullish. All right. So baseload, you can see that I've drawn Livermore cylinder here. So, but anyway, if you look at baseload, it's got like a perfect, exactly what you're saying, which is it's angling down like this.
It's a falling wedge.
You've got, this is falling wedge. This is bullish. And when you break out, like the move can be quite big after a breakout of bullish wedge formation. So that's right.
Another thing I always see when we break out of these patterns, they break up, and then usually they do a retest move, or they come back down, or they go sideways for a little bit. So someone will say it broke out, but it's not going anywhere. I should leave. I'm like, whoa. You want to buy all you can before that, because it's about to explode higher. That's the way I look.
That's right. So basically you break out, and then you can often come down to back test the breakout area. Like it's very common to see breakout, come back, and only time you would get concerned is when you break out, it could be a fake out. Like, I mean, there are so many fake outs these days, because like technical trading, like that's the only way that the big money can fake you out and like get more of your shares. Like, and a perfect example of that fake out that I'm talking about.
And you know what they call that sometimes? They call it a slingshot.
What is it called?
They call it a slingshot because what they do is they put a resistance line or support line. They hit all the stop losses, and then it just slingshots higher. You're like, no, I just sold that.
Yeah, that's right. So on Twitter, I think when everyone's like talking about the head and shoulder formation forming in CCJ, I was like, okay, it's gonna have a fake out. It's gonna come back up and it's gonna run.
It's a slingshot, like I said.
I'm saying if the pattern, that's right. So when the pattern's this obvious, like especially with the bigger caps, when where your smart money is playing the game with you, like you might see these fake outs a lot more. So you've got head and shoulder, everyone's like forecasting, okay, everyone's saying, okay, the projected move down then is here, down here somewhere. Like, I'm like, no, like this is way more likely that it's a fake out than a real head and shoulder pattern. So
well, how do you know
something
that?
to watch out.
How do you know that is a fake out pattern? Like what makes you think that? Is it because of the bullish fundamentals?
It's the bullish fundamentals and way that everything else was setting up, like U.UN. So obviously you know, the spot price of uranium determines where the uranium stocks will go effectively. So if you're looking at all these other charts, like not just CCJ, but if you're looking at URNM or URA or any of the mid cap miners like Bannerman or Deep Yellow, Elevate, like they were all forming bullish charts. So the order of this chart being bearish, like a genuinely bearish, was very low in my opinion. So like when everything's pointing it to being bullish and one stock, one uranium stock is saying that this is bearish, then I won't believe in it, basically.
Same thing. I do the same exact thing. And then I also look at the market conditions and say, hey, look, uranium's going up, the ratio's turning up, and you look at all these different things. I'm like, there's no way this is a bearish pattern. So then I changed my entire paradigm, and I'm like looking at this thing from the bullish perspective of how can I scare people out of this thing. Yep.
Yeah, that's right. That's it.
Okay, so I've also got
once again.
Go for it.
Once again with CCJ, your main player, you've got that, you know, widening bullish cylinder, Livermore cylinder. So everything's got it. Everything's got it. URA probably has it. Yeah.
So you came about to about this sequence of how, you know, you look at the charts, you do the fundamental analysis, you look at, like I call it, market conditions, you look at all these things. That's the same approach that I take. I will not enter a company that has a horrible looking chart. It just means that the investors see something that maybe I am not seeing. And how did you transition from being a new investor to like where you are today? Like, how did you get there? Like, what was the journey? And I know we're going over all these charts, and obviously you're basically a mere copy of how I do this too. But like, how did you go from like X to Y or from A to Z, or however you want to call it? How do you, like, did you take any training? Did you read books? Did you just like figure this out like yourself, and you were just like drawing patterns and they just started making sense? Like, how did you look at the Finding Value Finance YouTube channel and
no, so when I first started investing, like I think I was in the commodity boom, so I was quite lucky. Didn't really know what I was doing, but still made money. But even after that, one book that I really dug deep into was Benjamin Graham's Intelligent Investor. So I read that multiple times when I was a uni student. But any investment that I've made just purely based on fundamentals, like, just never worked out. Like, it's just I don't remember making any big money out of investing just purely based on fundamentals. Like, your PE ratio might be insane, or your PS ratio might be insane. So price to sales or price to earnings might be insane. I might go, oh, this is so undervalued. But you know, those things can take years and years and years to play out, like on in terms of share price movements. So I was like, okay, there has to be a better way of doing this. So I started looking at, like, just going through a whole bunch of charts, and you start seeing patterns, right? And you do, like, obviously research into what patterns are viable. I think when I first started investing, like maybe second year, I read technical analysis for dummies as well, and I started just collecting books. We weren't fortunate enough back then in 2000s, like the early 2000s, mid 2000s, to get access to like TradingView or the vast resources that are available on internet right now. So yeah, just started reading books, just started buying books. I think I must have bought like at least 5 technical analysis books. Yeah, so I just started reading them, started looking for those patterns in real life, and started finding them. And as you just apply it to practice and look at more charts and just build up your experience, it just becomes so natural. You see the patterns, and it just becomes very obvious sometimes. And sometimes I dream about it as well. Like when I see these patterns, like I subconsciously, I think it through, like during my sleep. and some of my best trades ever have actually been those I've just dreamt, like randomly dreamt of, like symbols, the codes, the symbols, and look at the patterns like on the day, and it might stick in my head on how good the pattern looks and how good the fundamentals might be, and I go in that trade, and like sometimes they become huge winners. So yeah, just experience, combination of active learning and experience.
I've looked at so many charts, it's ridiculous. So I could
Yep.
like pull up a chart, put no lines on it, be like, if that's good or bad. I could just be like, that's good, that's bad, that's good.
Same.
I could go through like 1,000 charts in like an hour or two and just be like, oh,
That's
that one's
right.
good. And then
Yeah.
and then when you go and you dig in, you're like, okay, this thing, there's a reason why it's creating this, and almost every
Yes.
time. So then I
Yes.
migrated myself to technical analysis over fundamental, and I don't even.
Yeah.
I mean, I still look at the fundamentals, but I don't look at it as much as I used to. And the one that
No,
kept
I
the
don't
stock
either.
that kept me up at night was SM Energy. That was the one. I
Yeah.
looked at it and I was like, this is it. Like, I just knew it was it. Like, I'm like, I've seen this thing a billion times. That's a lead into a massive move. And I had it right at the bottom of 2020 in like September, October of 2020. Because I was staring at it. It had the downtrend line. And I was just like, oh, this is insane.
Yeah.
And what's even more insane is the pattern. That pattern on the left, the entire pattern repeats over and over. It's the cleanest looking Elliott wave pattern that like I've ever seen. And that pattern is in everything. It's in Bitcoin, it's in all that stuff.
That's right. So so
I got it right in at that corner at $1.50.
Yeah. You see it on this Heikin-Nashi chart as well. Like, I mean, obviously with this, like you might have been faked out here, but I mean, you see a bit of momentum coming down, so probably not. So when it's like basing out like this and your body's getting really narrow and you get a green candle, like I'm like, yes.
So I bought it before the breakout. I bought it when it was down.
That's amazing.
And then it just it dipped down one last time. I bought some more and it took off.
Yeah, that's amazing. That's amazing.
But that was when I was
and you want and after you get into these Heikin-Nashis, one thing to look out for is that you want the rise to be quicker than the downtrend. So that's another thing that I look for. So if the rise is like this, so if the fall is the rate of fall, I think you talk about this, you talk about this as well. But if the rate of fall is greater than your rise, then you might want to get out. You know, like it's not playing out as you've expected. So always look for a breakout, like the change of trend to the upside to be quicker than the rate of decline to the downside.
Yeah, the another thing that you can look at is that's a form of momentum, is what I call it. It's you call it rate of change, I call it momentum. It's the same thing.
Yeah.
And when I look for that to flatten out and to slow down the rate of change there. And then I look at the ratios to back. I never take investments or trades without something at my back. Like the valuations have to be at my back. The market conditions have to be at my back. Everything has to be at my back.
Yeah.
Otherwise,
same with me.
No go.
Same with me. Yeah, no go. Yeah, that's right. Yeah, we think the same, Andy. I think someone commented the other day, like brothers from another mother. But yeah, I think I told you before. But I first came across your channel because like it was one of what it was showing up on my recommended list, and I was like vacuum cleaning, listening to you. I was like, this guy, like he thinks exactly the same as me. Like this guy is like my brother from another mother. And then someone.
You know what's even crazier is that I could see that you were like me by what you put on the charts, and that's why I wanted to put you on here, because I was like, I can see through his charts that he's similar to me, but maybe looks at things from a different perspective or viewpoint. Yeah. So how about this? What are some like examples where things went wrong? Like what happened where you made an investment and you were like, man, I really screwed this up? Like what were some things that you found out that you were going to enter a trade or you're going to enter an investment or something and it just didn't work? Like what, do you have any times like that?
I don't really remember any major screw ups other than 2011 when I think I've mentioned this before, but when I rode the silver down. So, you know, I had tons of gains. Like I think we were averaging. So obviously like my portfolio is small, but my dad's portfolio was up like 10 to 15x in total at one stage. So he was like just laughing. And that's across like 10, 20 silver miners in total. So some did like 30x, 40x, some did 5x, whatever it might be. So we were all big, but we wrote a lot of that down. And I think it really comes down to just understanding the market conditions and understanding the money flow. Like if the money's flowing out of commodities and it's evident through the ratios, then I think it's time to get out. Like you can't get married to a sector or a stock, because uranium, I feel like it's been good and it's going to be good. And you're going to get attached to it emotionally, especially if you're doing it for the first time. But then I think it's just so important to recognize that there is an end to all this. And there will come a time when I'm selling my favorite Explorer baseload. There will come a time when I'm selling my Elliott, you know? So yeah, it's really just really important to understand the market conditions and always be on a watch out for a major deflationary pressure as well, because, you know, major deflationary pressure can bring everything down. Like, because it causes liquidity events, it causes margin calls to, it causes margin calls, it causes, you know, a whole bunch of stuff which can cause liquidity events and can mean that all your commodities might come down, even if the fundamentals are strong. So looking out for market conditions, where we are in terms of the money flow, and yeah, just understanding the sector.
So how do you identify if a deflation or a market crash is coming? Like, what do you look for?
I look for interest rates. So the main thing that I look for is interest rates. Hold on.
So the 10-year yield, TNX?
Yeah. So Fed funds rate is basically what I start off with. So Dow Jones ratio. Sorry. And then, okay, I'll need to delete a whole bunch of stuff. But, oops. So this is probably the main thing that I look for. And obviously you've got like yield curve that I also go back maybe every week or every 2 weeks to just make sure that yield curve's not, you know, inverting. I mean, it's like almost inverted, but I think this one's a fake inversion, like the 2006 or 5 or whatever, whenever it might have been. But basically, like if you look at this chart, I'll just make it cleaner again. It's the time, because I think a little bit differently to you in this respect. This is probably where you think the housing drives everything, but I think it's the monetary policy that drives everything, because we have obviously, based on, you know, how much the Fed prints, you know, how loose the monetary policies are, you know, most of your money in the economy is actually created through the fractional banking system, right? Which means basically, based on the capital requirements of the commercial banks, they can either lend out or lend out more or lend out less. So I think that's what drives liquidity in the markets, like real estate, your general equities, everything. So what I really look for is pretty much, when did they start raising rates and how long did it take for the economy to tank? So you can see here, and basically what this shows is this, I mean, obviously you're and to some degree I'm agreeing with you indirectly in that I think housing drives the economy to some extent, because obviously if you look at the commercial banks now, I don't know what it's like in the US, but here in Australia at least, you know, you've got 60 to 70% of the banking books are mortgages. So it means that if your mortgages or if your property is not doing well and there are delinquencies, then, you know, the economy is going to fail. So so what you see here is, and how I interpret this is like, when everyone's coming out saying, oh, there's going to be a crash because we've just started raising rates, it doesn't happen that quickly. So if you just look at history, and if you just draw the line here, this was a rate rise. It took 41 months for it to play out, for it to actually hit the economy and cause a panic sell. Like, it's pretty similar here. Last time around, it took, you know, 4 years for it to play out as well. So it takes time. And the way that I look at this is this, like, and the delay effect is so like logical if you think about it, because when you start raising rates, and people need to start paying more for their mortgages or the loans that they might have. Same with the companies as well, you know, until it hits until it becomes a delinquency, it takes a long time. So first of all, you need to dwindle their savings rate. So we've seen the savings rate come down quite dramatically after COVID when they opened everything up. So that's the first sign. And then what happens then is it causes delinquencies, but delinquencies you won't see immediately either, because it might move into the 30-day delinquency, 60-day delinquency, 90-day delinquency, and then eventually, like after many months, maybe 6 months to a year, or maybe even longer than that, you'll start seeing defaults in housing or defaults in mortgage repayments. So it takes a long time. And then for the banks to actually recognize that and write that off as bad debt, like that takes another 6 to 12 months. And for it to hit the securities that are backed by mortgages, for example, or whatever it might be, that takes another 6 to 12 months. So there's delayed reaction in everything. So just because you raise interest rates right now, it doesn't mean the economy is going to get smashed down, because there are delays in every single step of the way. And one thing that I look at is, and this is where I connect with you, I think, in terms of, you know, housing is important. Yeah, 100%. So if you look at the delinquency rates, so, okay, let's actually start with the savings rate. So if you look at the savings rate and how much of a warning it gives you, typically, it's a long time. So what happens here is you've seen a major dip here, 1987, and then you didn't have a crash until 1990. So it gave you like 3 to 4 years warning. You saw a dip here in 1999. Okay, so this was a little bit quicker. You saw a crash maybe two years later. You saw a dip here. You saw a crash like 2-3 years down the road. And what you see here is you see a dip here, but you still have plenty of time, because it's not an immediate warning sign. But what becomes a little bit closer to the date is the delinquency rate. So this is delinquency rate. Sorry, were you going to say something, Andy?
No, I was thinking, like, if there was a ratio that we could come up with that could predict liquidity events based off of leading indicators against each other. That, I mean, I was just trying to think, because then, I mean, this is like literally an award-winning book. What you'd want to do is what you're doing is you're just driving back the root cause and saying, what's the leading indicator and how could we see it? So I'm saying delinquencies and home starts are obviously interconnected. And then savings rate would be the one before that, right? So you're just driving back further than me.
Yeah.
So you keep going back and back and back. Yep.
So yeah, you'll see like a couple of weeks before the recession hits, and this is once again like not an immediate indicator. Like you need to see this come up and see the rounding bottom before it actually, you know, hits that recession mark. So you see it flatten out. It's like exactly like the charts, right? Because you see the change of trend is what you see. So
yes,
so
you would see inventory increase in homes. You'd see the home starts start to fall, and then these kick on. All at the same time.
That's right.
All at the same time.
That's right. Yeah. So you know, if the car's traveling at 120 miles per hour, like just because you put the brakes on, it's not going to stop immediately. Like the momentum, the law of inertia will carry it through for years and years. And so you see a rounding bottom here, and then you see the delinquency rate come up, and then it shoots up, recession, right? This is much less, you know, relevant because obviously this was a tech bubble. So your Dow Jones didn't even fall that hard during the 2000s bubble, but you know, you still see the rounding bottom to some extent. So what I'm expecting to see similarly is obviously your savings rate came down. So maybe 6 months, 12 months, maybe I'll see the delinquency rate flatten out a little bit. And maybe if I see it start coming up, but it still gives you plenty of warning, you know, like you've seen it come up. So this is 2006, like that's 2008, you know, it still gives you like a, you know, 1.5 years, 2 years warning.
You can do your trend line too and draw it across. And when you break the trend line, then something's changed. Just like we were looking at earlier on technical analysis. I think if you tie what you have here with housing starts, I think it'll be the strongest picture, because the housing starts never really dipped in 2001. It was like contained. And that's where I think it will, because look what happens to the housing starts before every recession. They always drop. It's like it's
all related, right? Because mortgage
All
rates
related.
rise, your savings dwindle, like people can't, purchase new homes and the housing starts to go down. And yeah, I agree. Like housing is like a big part of the market. We saw, in our previous presentation that residential housing is worth like $70 trillion in the US, which is like only $30 trillion less than the general equities market. So yeah, it's the combination of the general equities market and the housing market that will drive that will drive the general economy.
For Edward Leamer, when he did his paper, he said that basically anything with loans. So an expansion of the loans is inflationary, the collapse of the loans, and that could be anything. It could be car loans, home loans, margin loans in stocks. It could be anything.
Yeah, that's right. That's exactly right. And another important indicator, I mean, obviously, I don't know if you want to go through the yield curve, but another thing that I look for is corporate profits. Because that can also be a pretty important indicator. Like if the corporate profits are shooting up, you're not going to see a recession. So,
but this may not result in a deflationary recession. It could be an inflationary recession, right? Stagflation.
It could be
type move.
It could be. Which okay. So that opens up another discussion, which is, are we ever going to, see a crash? You might not. Like, I mean, I'm not really betting on a crash either. Like, there might be a deflationary pressure, but I'm not going to bet all my money on it because this is probably this could be a scenario where the general economy is not doing that great, but because of the inflationary pressure, you just go side. This is Dow Jones, by the way. Because of the inflationary pressure, you're just going sideways for like 20 years. This could be another scenario that might be worth considering. So I'm not necessarily calling for it. Yeah.
It goes sideways, but all the value gets sucked out of it through the currency, and it performs poorly against other assets. You'll see that in the ratio.
And check out what silver did during this time. Silver's run was absolutely epic.
Yeah, absolutely massive domination by silver.
Yeah, hold on. Okay, hold on. Let me just delete that again. Silver, you pain. So if I zoom into this period, look at silver.
Yeah.
Look at silver. Silver's pretty much gone from $1 to $6 here, and then from $4 to $50. So during the same period, and this is kind of why my silver's next play, because I think we've got the inflationary pressure. I think ultimately there will be monetary demand for the physical metals and gold, metals, including gold and silver. So you've effectively had $1.30 silver right at the bottom in 1970. And for the whole time that Dow Jones stayed steady, silver went up to $50. So that's potentially an outcome, yes.
Yeah, and in the middle of that, we had a housing start collapse, and then it went back. So silver, you could see it in the silver chart. Do that little.
That's right, and that's the deflationary pressure that I'm kind of thinking.
Yep.
So this is where I'm saying, yeah, there might be a deflationary pressure. It could just be that commodities run too hot. That the profit takers stepping in and then they start selling out. They don't really want to get into general equities. They don't really want to get into housing, which means that if you're just holding money in the savings account, it's not really going to create new money supply. It's not going to contribute to the growth of money supply, which means there could be that deflationary pressure. So I don't know exactly how that deflationary pressure will look like. It could be a mini crash in the general equities, or it could just be the profit takers. I don't know. I'm not going to try and predict that. I'll just observe like these data points as they come in. But yeah, that's why I expect a deflationary pressure, because we've seen that in the 1970s, we've seen it in the 2000s, and I just don't think it will play out any different this time.
Yeah, I agree. Do you what do you think about people who make all these price predictions or predictions based off of interest rates and the housing market's going to crash? Do you need to do any of that, or is it just you can study this? It gives you enough forewarning where you don't have to make any predictions. You just watch it and react.
Yeah, you don't need to. Like, I mean, if the momentum's there, I don't see any reason for selling anything. So if I'm seeing with housing, I don't know, like I'm not an expert on housing or anything like that, but the way that I look at it and way that I look at the US housing right now, it's very much undervalued compared to the Australian market, the Canadian market, the New Zealand market. And I think it could run a long way from here.
Say that one more time. I don't think I heard that correctly.
US houses are cheap compared to Australia, you know, like and Canadian, whatever it might be. I think we talked about this before, but you know, like take your traditional metrics around housing prices. So if you look at median household income to house price ratios, for example, in the US, I think it was like 6. In Australia, it's like over 10. So, you know, the valuation gap is huge between the US and Australia and Canada as well. Like New Zealand is trading even higher, I think. So there's a lot more room. And another thing with US is, you know, there's been a major cleanse out of the housing market back in 2000s, back in 2008. It was the housing crash. So once the systems cleans out like that, and once you start with fresh book in terms of your loans, like it might take way longer than people expect for it to actually, you know, start affecting the housing prices. And yeah, why would you try and predict the housing prices, and why would you try and front run it? Because what you can look at is delinquency rate. It will tell you.
You look at your leading indicators. When they all start turning negative, you're like, okay, it's gonna come. I just gotta look at
and you will know way before the housing prices come down, in my opinion. So if you look at this, for example, if you look at this, the delinquency rates coming up like this was a warning sign to you. So you could have looked at this going, okay, here's a massive trend. Like you can draw almost a line across this.
Yep.
Here's a massive trend in delinquency rate. It's been coming down, 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 down. Now it's turning up. Okay, or it's broken out. Okay, let's sell house. Like that could, you could do that. This is an early warning sign. You don't need to like try and time this perfectly. Like just go with the momentum. Like for me, like the biggest mistake that I've tried to make is trying to pick bottoms. Like I just don't try and pick bottoms or tops.
Mm-hmm.
I just wait. I just wait for the money to start flowing in or out.
Yeah, that's the same thing, basically what I do.
And it's exactly the same thing with commodities. And we've talked about this where, you know, you will see the money flow out through the bigger miners because they offer the liquidity that the smart money offers. And so an easy, like, I'm not saying this happens, but it's so easy for the big institutions, for example, to pump up the uranium prices because it's so like such a small market, pump up the uranium prices and then start selling their shares. So they can effectively kind of control that. So when you see the big miners come down, you're seeing the money flow out of the sector. And when you see relative underperformance of the bigger miners, then you know that money's flowing out, and that's a warning sign. So once again, I think there are so many like smarter ways of playing the game than just trying to predict where the top is or where the bottom is. You look for the signs of money flowing in or money flowing out, and you can do that through ratios. You can do it through like warning signs like this. I think there are just so many ways to play this. Play it smartly.
Yeah, I that's exactly what I do. I just look to see what's the driver of liquidity, and then when that goes away, it's done. you got no more liquidity, and then the market conditions will change because interest rates will come back down. The driver of money coming in the system is the same driver of it leaving the system for a deflation. And when people start making predictions, they're like, well, home prices, when they get to a mortgage rate of 5%, will completely, it's like, I don't need to make the prediction. Just follow the leading indicators.
That's right.
And
look
that's
at delinquency rate. Look at whether people can actually afford it or not. If they can't afford it, it will still take a while. It takes time. Like, you know, it takes time for banks to actually start recognizing and start writing it off and start, you know, foreclosing homes. Like it takes time. So, you know, you can use these early warning indicators and like in Australia, for example, I think it's false to think that, you know, housing prices will fall just because of rising interest rates. Because if the percentage of your income relative to what you if what you're paying mortgages is small relative to your income, which I believe is what's happening in the US because of like low interest rates, not only low interest rates, but very like undervalued, I wouldn't say underpriced homes compared to other countries like Hong Kong, Australia, New Zealand, whatever it might be. We've talked about this before, like you know, like the same type of looking houses can cost like 2, 3, 4, 5 times over here in Australia than in the US. So yes, people still have a lot of buffer in terms of what they can pay in mortgages. Like, so they're spending because of the rise in interest rates, your repayments might go up by $1,000, $2,000, but you've got the buffer. You've got the buffer because of the relatively low housing prices in the US compared to other overpriced countries. So I think, no need to check, no need to predict the top.
Yeah, that's exactly what I do. And one of my indicators is housing starts, inventory going up, days on the market, and foreclosures, and high interest rates. That means you're at a top.
Yeah.
Yep.
Yeah. So this is what's really interesting as well, because like if you think the interest rates actually drive housing prices that immediately or imminently, then just look at what happened, right? So let's just go back to Fed funds rate.
Mm-hmm.
Hey, it's not true at all.
Well, that's what I say. It's not true at all.
So 2004 was when they started raising rates. Like, we've just started raising rates. Like, you don't even see that on the chart yet. No. 2004 is when they started raising rates. When was the housing crash? 2008, 4 years.
There is a difference, though. There is one difference that I will say, is that when you come from a very low level, if you come back up on a percentage terms, that is a large percentage term difference.
Yeah. It is.
That's the only thing I'll say. It is. Because you go from 0 to 1, that's like an infinite gain because you came from nothing.
Yeah, but there are so many cases where rise in interest rates didn't cause housing crash at all. So look at this, 2015. Well, you came from pretty much the bottom, and then you went to 2.5. There was no housing crash. I didn't see any housing crashes, did you?
Right. The house prices go up when interest rates, and then interest rates follow with it, because interest rates are a function of people selling bonds due to inflation or a real negative rate. So, and I don't think that the government, or I should say the Federal Reserve, I don't think the Federal Reserve can control rates. They can do it to a certain extent, and then they'll lose control because it just takes too much money to control it, because it'll be fueling more inflation. It's like a self-feeding loop that they get stuck in, where they're like, we have to pull back. Like, we can't do this anymore. It's gonna like blow things up inflation wise. That's, at least during certain market conditions, it turns into that.
Yeah, but another thing is, I think we've talked about before, it's all about the money flow and how much money or how much liquidity is in the system. So the Fed's been printing money, the commercial banks have been expanding their loans, which means money supply has gone up, shot up like crazy. And if you think about it, like, I mean, the money that's been made here in Dow Jones, and even crazier, if you look at like QQQ, for example, like all the money that's been made from here to here since the last crash of 2008, like that's effectively money that can kind of cover off on your mortgage loans as well.
Yes. So, and another thing is, that's the fuel for the stuff that's going to blow up uranium and these other commodities, because all that money went into these assets. And when people see their accounts starting to go down, they're like, just move it. They're all FOMOing out and over.
That's right.
So that's the potential fuel that's going to go. And we've never had this large of an imbalance before in the markets in terms of commodities being priced so cheaply to stocks. So
that's exactly right. So I mean, for me, it doesn't really matter whether, QQQ comes up or goes sideways or has a blow off top or comes down a little bit. As long as there's no crash, like, I know that commodities will massively outperform QQQ and DJI. So I don't really care. I honestly don't care what QQQ is doing. I'm the same way.
I always say it could come back down. It could go sideways. It depends how much money they print. It depends where it goes, but all I care about is the commodity price. The commodity price is outperforming.
That's right.
Yep.
I don't have the crystal balls to know where DJI or QQQ is going, but all I know is that money started flowing out of general equities into commodities. That's all I care about, and that's all that matters to me.
Yep. And it's at a 100-year low. It was at a 100-year low when it bottomed. Which means the money's not there. And then if you look at the market balances and all the other fundamentals of these companies, it all goes insane in 2023, 2024. They all go into these massive deficits. And I'm just like, oh my God, this will be the biggest bull market that I've ever seen, because the conditions in the actual, the actual things that they produce go into these massive deficits coming up in like 2023, 2024 for almost everything. It's just a whole bunch of things going into deficit.
Yes,
so
100%.
Yeah, and these guys know it. That's why they're swapping money over.
Oh, 100%. The institutions know it for sure. The smart money knows it. They're gonna. I don't know. I don't know. I feel so bullish about the commodity sector right now that I can't sleep at night because of how bullish I'm feeling. I'm just like,
problem with me,
how crazy is it gonna get?
The problem with me is I look at all these different like sectors and they all look insanely good. Everything. I'm like, graphite, lithium. Then you look at like uranium, then you look at oil and natural gas, you look at coal. I mean, you pull up anything, they all have these double bottoms, rounding bottoms. They've got bullish cylinders left and right. And then you start looking at the fractals of everything, because now you're trying to pare down what you should go into. Then I start doing ratio calculations. I'm like, well, if this was the last one, peak to bottom was this amount, this is the new amount, and this is roughly the leverage that I'll get if the ratio were to compress back to historical standards in each of these different things. So then I try to tie the fractal in the chart. I try tying the potential move that you could have in the underlying commodity, and then I just pick things off. And that's how I've been doing it. And it almost matches perfectly up with what you do. So it's like, it's ridiculous. And if you guys are interested in this, definitely sign up to the website below, because this is the exact stuff that I go over is what we were talking about right here. It's the exact thing.
We talk about, so this is really funny that we're doing this, because like we were just chatting and then we're like, we should just record this anyway. Like this is the type of chat that we've been having for weeks now. And like, and it's so valuable.
Now here's something else that I noticed. There's two main things that you have to learn. One is the market conditions, ratios, knowing when it's the right time to invest. The second thing is the vehicles that you select in order to be successful in extracting that value. Do you agree with those two separate things? The first is, so you can get the commodity bull market right, but you could majorly mess it up with the wrong picks. I mean, you can still probably make money, but you won't make nearly as much money if you knew what you were doing. And you can, another thing, if you don't have the first section where you have your timing of your commodity and all you have are your fundamentals, then you still mess it up. You could have the best companies in the world buy it all at the wrong time, and you just get slaughtered, like 90% downside.
Yes, 100%. Yep. You need the money flow into the sector, the right sector.
So you need the value and market conditions for this to all turn and the money flows to step in. Then you have to choose the right vehicles. And I think that's where like yourself and myself and maybe some others, in all honesty, on YouTube, I haven't really seen too many people like nail it. I like listen to it and I'm like, man, they're off on this. Or you listen to someone else and they're off on that. Like what? It's so hard because they'll say something like, a lot of these gurus, and I'm not going to give names because I don't want to call anyone out. I'm not trying to say this from a bad perspective or viewpoint, but I would listen to these guys and I would just get slaughtered all the time. You hear people, you're going to have a crash. Like some people were saying that we'd have a crash in 2012, 2013, 2014, 2015, 2016. You could probably guess who I'm talking about, who calls out a crash every single year. Then you've got people saying that gold's going to go to 5,000 to 10,000 every single year since 2009. And you're like, okay, what is going on?
The money flow's not there. Like
they're not there. And what I look for is
like you need the money flow.
So I like literally dug into all this myself, and what I came up with was exactly what I've shown on the channel. And obviously you may view things a little bit different than I do, but it's very similar.
Okay, so like what we're talking about with money flow in terms of gold is like, I'm bullish gold, but like, I mean, it's not, this doesn't look like a chart that's just ready to take off. Like, I mean, very long term, this is a very long term monthly chart, very, very long term. I'm bullish gold, but very long term, it could start rising, but like it doesn't really have the momentum that you see in uranium.
Oh, uranium's going like vertical that last month or two.
Uranium is like
It's
just
turning
broken
like-
out of this. Like gold is not there. Gold is like maybe here. It might go like
Yeah.
it might be a
A
slow
little bit
grind
longer.
up.
Yep.
I mean, uranium looks like it's ready to take off.
Oh, uranium looks ridiculous. So does, like, if you were to look at oil
It looks
too,
ridiculous.
against gold, it's like, oh my goodness, this thing's like the largest compression I've ever seen from the bottom of 2020.
Yeah.
The bottom of 2020 is off the chart. That's where I was like, I just dropped everything.
That's
I was like,
right.
I gotta
Fake
buy oil.
out. This is fake out. Like how clean is this chart? This ratio, like measured in gold, oil prices measured in gold, you get like perfect like support areas, and then you break, fake out, and then you go up.
The slingshot pattern. Boom.
Slingshot pattern is my favorite.
And the reason
why I went so heavy on
the reason it's a slingshot is because when you go so far to the downside, it messes up all the fundamentals. Like companies start going bankrupt.
Yeah.
They can't produce anything. They're losing money. It's all like just jacked up. And then what happens is the price overcorrects to the upside, AKA the slingshot.
Yeah, that's exactly right. That's exactly right. So yeah, slingshot pattern. So I think I mentioned before that I went heavy silver, like during March 2020. It was like when I went all in silver, I was like, this is it. I'm gonna get as much silver as possible. The reason for that is technical analysis. Like you've had like slingshot pattern right here. So basically you can see it. This chart is really messy because I've got so many things on, but this line here, you've got support here, like resistance here. Like you've got so many like confluences of support and resistance. And then when it came down and broke this level, I was like, okay, this is gonna be a slingshot pattern. Let's wait for it. And then when the Fed announced QE infinity, I was like, okay, this is a slingshot pattern. So,
yep.
Yeah, and look at the slingshot. Like this is what Andy means by slingshot is that once you have these false fake outs, like that's what creates the biggest moves.
Yep.
Like slingshot patterns are brilliant for that. Like creates really, really big moves after that. So look at that. That's insane. That was insane.
And the other thing to verify is if your price goes below the high cost producers and even the medium cost producers, that's the lowest risk way to buy something. Like there is nothing lower risk than that ever. So like platinum, when it went down, it got below the lowest cost producer. And I was like, oh, this is ridiculous. I started buying everything in platinum at like $600, $700. Like this is not sustainable down here. It was like free money. I was like, okay, I'll pick up this stack of $100 bills. I'll pick up another stack of $100 bills.
Yeah, well, that's what we feel like right now with uranium, right? Like, I mean, cost of production
below the cost curve.
Like
it's not sustainable. Like, it's not sustainable.
Like despite the hype and everything, like on Twitter, obviously, like I don't know, obviously no one else. I don't think the general public's aware at all around uranium, but you know, like you've got like Twitter people thinking that, oh, are we? And sometimes you get caught in that environment, that community where you think, okay, well, has the actual story been caught on by the general public? But it hasn't been at all. And yeah, exactly what you said. A good indicator of that is that, you know, the cost of production is still higher than your spot price of uranium.
Yep.
That's what's like, mind blowing.
Well, here's the thing. People on some of these things, they're like, they've run like 800-900%. It's definitely a top. It's coming down, and it's like, the price hasn't even gone over the high cost producers yet. Like there's no way, in my opinion, that this is even close to a market top. A market top goes vertical, and it's going to go so vertical that you're going to be far away. You're going to look down, and you're going to be like, look at the cost curve down there. It's way down there.
Yeah.
And
that's exactly right. So this could be a Fed. I'll pull up another chart, but something cleaner. Let me just pull up QQQ or DJI. Okay, so what Andy's talking about, and let me know if you agree with this.
Do you know what causes that? There's a bunch of stop. So under these resistance lines, what people do is they put stop losses. And this is a reason I don't put stop losses.
Yeah,
They
that's
put
right.
stop
That's right.
losses underneath.
Yeah, they
The
fake it up.
the market makers know where they're at. The banks who
Yeah.
run all this, the
Of
market makers,
course,
they
of
know
course they
exactly
can
where it's
steal
at.
that.
And you know what they do?
Exactly.
They say,
Yep.
I'm going to run
They
all
just-
those stops and pick up everything. So
Yeah.
it goes,
Yeah,
and then it goes
exactly.
back up and slingshots
Pause,
the other
yeah.
way.
I know. So that's what's so crazy. But yeah, what Andy's talking about is like, if you look at uranium, like obviously I'm just using this as, well, this is for demonstration purposes, not saying DJI is like this, but like what uranium's done basically is that like fair value, let's say this is fair value, uranium was trading like way below here. And so now they've just come up to like undervalued because the cost of production is still like cost of production is higher than spot price. So it's still like below fair price. And what it's going to do is play a massive catch up to the fair price and then overshoot to the max because of how small the market is for uranium. And so yeah, when people say that just because it's on 10x, it's overvalued, that's a bunch of, I don't know, nonsense to me.
They're looking at price movements and not the relative value or the value of it.
No, that's
of
right.
uranium itself.
Yeah.
And these things
Yes.
were so beaten down that it's like
Yeah.
the first fresh of breath air that they got, they kind of like lifted up to
Yeah.
a respectable
Yeah.
level, I'll say.
Yes. Yes.
So
that's right.
yep. I totally agree. And we should probably end it here. I mean, we've been on this for a pretty good time. So
Okay.
we can end here. We've got a whole bunch of
Sounds
stuff
good.
to talk about, obviously.
Yeah, I mean, we
go
could
on
talk forever, right?
I know we could go forever. Okay, so we'll stop it here, guys. Hopefully you guys like the content. John or Scott's been absolutely, I keep wanting to say John. I don't know why. You said John earlier, and now it's like stuck in my head. Yeah, Scott's thanks for coming on, Scott. I really appreciate it. They can find you
Thanks for
at
having me.
his Twitter handle, Twitter name at
Yep.
U_AG_. Mine is at finding_finance. That's my Twitter. If you want to check out my website, you can do that. It's in the description link below. You can check that out, become a platinum member. We'll probably I'll maybe even post this early on it. We'll see. And what we can go from there. So thanks for coming on, Scott. I really appreciate it. Thanks again.
No problem, Andy.
All right.
Thanks for having me on.
We'll catch everyone next time.
Okay.